Welcome back to the Accounting Analyst channel. Today we'll be discussing something that is at the heart of all accounting and finance, the financial statements. Financial statements are critical for assessing the financial health of a business. They provide a structured and detailed overview of a company's financial performance and position. There are three main financial statements: the income statement, the balance sheet, and the cash flow statement. A fourth financial statement, the statement of changes in equity, shows changes in shareholders' equity over time and usually follows the income statement. For this video though, we will be focusing on the three main financial statements: the income statement, balance sheet, and cash flow statement. Financial statements are formal records of the financial activities and position of a business. They provide detailed information about a company's financial performance, cash flow, and financial position. And as I mentioned, the three main financial statements are the income statement, the balance sheet, and the cash flow statement. Each statement serves a unique purpose and provides different insights into the business's financial status. First, we look at the income statement. The income statement, also called the profit and loss statement, shows a company's revenues and expenses over time, over a specific period of time. It provides insights into the company's profitability. Some key components of the income statement are: 1. Revenue. This is the total amount of money earned from sales of goods or services. 2. Cost of goods sold, or COGS for short. These are the direct costs incurred to produce the goods or services sold by a company. 3. Gross profit. This is revenue minus cost of goods sold, and this shows the profit a company makes after accounting for the costs associated with making and selling its products. 4. Operating expenses. These are the costs required to run the company that are not directly tied to the production of goods or services. For example, management salaries, rent, utilities, etc. 5. Operating income. This is your gross profit minus your operating expenses, and this shows the company's earnings from its regular operations. 6. Other income and expenses. This includes non-operating items such as interest income, interest expenses, and taxes. And 7. Net income. Your net income is the profit or loss after all revenues and expenses are deducted, including taxes. Next, we look at the balance sheet. So the balance sheet provides a snapshot of a company's financial position at a specific point in time. It shows what the company owns, which are called assets, and what it owes, its liabilities, and the value of shareholders' equity. Shareholders' equity is the ownership interest in the company. The key components of the balance sheet are: 1. Assets, which, as I mentioned, are resources owned by the company. And assets are divided into current assets. These are items that can be changed into cash within 1 year, and this includes things like cash itself, accounts receivable, and inventories. Non-current assets are long-term assets. Things like property, equipment, and long-term investments are usually held for more than a year. Second component of the balance sheet is liabilities. Liabilities are obligations the company owes to others, customers, suppliers, etc. They are divided into current liabilities, which again, like current assets, are due within 1 year, and these include things like accounts payable, short-term debt, etc. Long-term liabilities, on the other hand, are typically due in more than 1 year and include things like long-term debt and deferred tax liabilities. And the third component of the balance sheet is equity. Equity is the residual interest in the assets of the company after deducting liabilities. So equity includes common stock and additional paid-in capital, which is money invested by shareholders. And it also includes retained earnings, which are accumulated profits not distributed to shareholders as dividends. So the balance sheet reflects the accounting equation as we mentioned in an earlier video, and that's assets equal liabilities plus equity. And as the name suggests, it's a balance sheet, so it must balance at all times. Let's take a look at some of the valuation methods for balance sheet items. Items on the balance sheet can be valued in several ways. These include 1. Historical cost. Historical cost is the original price the item was purchased for. So whatever you paid for it, that's the historical cost of the item. Fair market value. This is the current market price of the item. And then 3. Book value. Book value is the historical cost minus depreciation. Certain items on your balance sheet will be carried at different valuation. For example, if you have equipment, that's going to be carried at your historical cost, which is the price you bought it at, minus your depreciation, and that gives you your book value. Certain other assets like investments and certain types of debt may be carried at fair market value. So there are different valuation methods, and certain items are carried at different valuation on the balance sheet. Next, we look at the cash flow statement. The cash flow statement shows the inflows and outflows of cash over a specific period of time. It helps assess the company's ability to generate cash to fund operations, pay its debts, and to invest in future growth as well. Without cash, none of these can be done. The key components of the cash flow statement are operating activities. These are cash flows from the primary revenue generating activities of the company. They include cash receipts from sales and cash payments to suppliers and employees. Second component, investing activities. Investing activities are cash flows from the purchase and sale of long-term assets and investments. And the third component, financing activities. Financing cash flows are cash flows from transactions with the company's owners and creditors. And they include things like issuing or repurchasing stock, borrowing or repaying loans, and paying dividends to shareholders. Let's look at some key relationships for the cash flow statement. The ending cash balance on the cash flow statement should match the cash balance on the balance sheet. So if this is not matching up, then you know that something is wrong with either the cash flow statement or the balance sheet. The second relationship is that the net income on the statement, the net income on the income statement is the starting point for cash flow from operating activities. This is always the case. And 3, changes in assets and liabilities on the balance sheet are reflected in the cash flow statement. Let's now look at some financial statement examples. First, we'll start with the income statement. And here we see the income statement starts with revenue of 500,000, cost of goods sold 300,000, leaves us with a gross profit of 200,000. That is 500,000 revenue minus cost of goods sold of 300,000. Next, your operating expenses such as salaries, 50,000, rent, 50,000, and that leaves us with operating expense of 100,000. Operating income, which is the gross profit of 200,000 less the operating expense of 100,000, is 100,000. Then there we have some non-operating expenses. This will include things like interest expenses, and this is 10,000, which is a negative here, and that leaves us with net income of 90,000. That is 100,000 in operating income less 10,000 in non-operating expense. So that is an example of an income statement. Simplified here, in practice it might look way more complex than this. But that's how an income statement would look like in the real world. Next, let's take a look at a balance sheet. So the balance sheet will start with assets at the top here. And here we have assets such as cash, 50,000, accounts receivable, 75,000, inventories, 100,000, and these are what we call current assets. And current assets are those which can be turned into cash in less than 1 year. And the total for our non-current assets is 225,000. We next have long-term or non-current assets, such as property and equipment, which is $200,000. Long-term investments, $75,000. And this gives us total non-current assets of $275,000. So our non-current asset or current assets plus our non-current assets gives us total assets of $500,000. Next, we have our liabilities and equities section. Our liabilities start with current liabilities such as accounts payable. Here it's $50,000. Short-term debt, $25,000. Gives us total current liabilities of $75,000. Next, we have long-term liabilities such as long-term debt, $150,000. Deferred tax liabilities of $25,000. And that gives us total long-term liabilities of $175,000. And similar to current assets, current liabilities are those that are due in less than a year, and long-term liabilities are due longer than 1 year. Next, we have equity, and equity can be composed of things like common stock. That's the amount that investors have invested in the company, shareholders have invested in the company, and here it's 100,000. We have retained earnings. This is the profits which have accumulated in the company over the years, which have not been paid out to shareholders. And here that is 150,000. So adding these two gives us total equity of $250,000. Adding up the liabilities or total liabilities of 75,000 plus 175 plus our equity of 250,000 give us total liabilities and equity of 500,000. And what do we notice here? Our liabilities and equity is equal to our assets. And this again is the accounting equation, which is assets equal liabilities plus equity. So these two must always be the same. So your balance sheet will balance. If the balance sheet is not balanced, then something is definitely wrong with your accounting. Next, we look at a cash flow statement. The cash flow statement has 3 sections: operating activities, financing activities, and also investing activities. So we start with operating activities. And this is cash generated from the company's normal operations. Here we see cash receipts from sales, 400,000. That's a cash inflow. Cash payments to suppliers, which is an outflow, is 200,000. And payment for operating expenses, again, that's going to be an outflow because it's an expense, and that's 100,000. And all 3 of them summed together gives us net cash from operating activities of 100,000. Sometimes this could be an outflow, but in this case, it's actually an inflow. So we have 100,000 in net cash from operating activities. Investing activities, we have purchase of equipment. This is when investment is made into or out of the business. So purchase of equipment, that's an investment, but you have to pay for the equipment. So it's a cash outflow of 50,000. Sale of investment, so the company might have some funds it had invested in securities and it decided to sell some of those. So it gets cash, and that's an inflow. Netting these two gives us net cash from investing activities, which in this case is an outflow of 20,000. Next is financing activities. Financing activities include things like issuing common stock to shareholders, and that's an inflow. Here it's 50,000. Repaying long-term debt or other type of debt, that's a cash outflow, and in this case it's 30,000. These two net together gives us net cash flow from financing activities of 20,000. And in this case, it's an inflow similar to the net cash from operating activities. So we had 2 inflows from operating activities and from financing activities, and we had an outflow of 20,000 from investing activities. So that leaves us with a net increase in cash of 100,000. So over the course of whatever period this cash flow statement represents, this company would have taken in a net cash of 100,000. We then add cash at the beginning of the period, which in this case, it was 50,000. So at the start of the financial statement period, the company would have had $50,000 cash in its bank account, and then we add it to the increase in cash, and this gives us cash at the end of the period of 150,000. So this 150,000 should be in the company's balance sheet at the end of the accounting period. So those are examples of financial statements in practice. That's an introduction to the 3 main financial statements. We'll now take a look at notes to the financial statements. Accompanying every set of financial statements are notes, which provide important additional information. This includes information such as accounting policies used in the business, a breakdown of complex line items on the financial statements, disclosure of risks and uncertainties, and details on debt covenants, lawsuits, and other potential issues. And there are usually a lot more disclosure on the financial statements. These are just a few. Reading and understanding these notes is essential for a complete picture of a company's financial situation. So please don't ignore them. Having financial statements is one thing, but if you don't understand how to read, interpret, and analyze these financial statements, they're not going to be of any good to you. So let's take a look at analyzing financial statements. Understanding how to analyze financial statements is important for gaining insights into a company's financial health. And here are some key metrics and ratios to consider when analyzing the financial statements. 1. Profitability ratios. Profitability ratios measure how effectively a company generates profits. Examples include gross profit margin, operating margin, and net profit margin. Liquidity ratios. Liquidity ratios assess a company's ability to meet short-term obligations. Examples include the current ratio, which is current assets over current liabilities, and the quick ratio, which is also called the acid test ratio. And this is cash and cash equivalents plus marketable securities and accounts receivable, all divided by current liabilities. Third type of ratio, solvency ratios. Solvency ratios evaluate a company's long-term financial stability. And examples include debt to equity ratio, which is total liabilities over shareholders' equity, and the interest coverage ratio, which is calculated as earnings before interest and taxes, or EBIT, over interest expense. This shows you the amount of cushion a company has to pay interest on its debt. Fourth type of ratio, efficiency ratios. These ratios indicate how well a company uses its assets. And examples include inventory turnover and accounts receivable turnover. Turnover ratios basically tells you how quickly a company is turning over its assets. For example, inventory turnover tells you how quickly a company is selling its goods. The quicker is the better. Accounts receivable turnover tells you how quickly a company is collecting its receivables. And again, quicker is better because the company would be bringing in cash faster from its customers. You always want to be collecting your receivables as quickly as possible. Okay, we're getting close to the end of this video. So let's try to summarize. Understanding the 3 financial statements and how they interrelate is critical for assessing a company's financial position, profitability, and cash management. Each statement provides unique insights. The income statement shows profitability and operational efficiency. The balance sheet, on the other hand, provides a snapshot of the business's financial position and solvency, its ability to pay its debts. The cash flow statement highlights cash management and liquidity, How much cash is the company generating, and does it have enough cash to meet its obligations and to invest in the business? By analyzing these financial statements, business owners, investors, and other stakeholders can make informed decisions to guide the company's financial strategy and growth. This brings us to the end of the video, and I do hope you learned something here that you can apply in your business or in your personal life. Thanks again for joining us, and as always, remember to like, share, and subscribe, and I will see you in the next video. Peace out.